Welcome to the Deep Dive. Today we're plunging into a story that honestly sounds almost unbelievable. Picture this: a software company in Omaha, Nebraska. Solid business, around since 1976.
Wow, that's a long run.
A really long run. Nearly half a century, consistently profitable, never even needed a loan. But then, 2023 hits.
And things changed.
Dramatically. They were suddenly forced to go out and get financing for the very first time. Not for expansion, not to ride out a bad patch, but to pay a massive federal tax bill.
Just to pay taxes? That sounds odd.
It gets weirder. Their taxable income apparently tripled overnight, even though, get this, every single dollar of that supposed profit had already been spent on their engineers' salaries.
So the money was gone, but they owed tax on it.
Exactly. And this year, they're looking at owing taxes equal to an astonishing 95% of their book income. 95%.
Wow. Yeah, that Omaha story, as rough as it is, it's unfortunately not some isolated incident. We're hearing this across the U.S. Thousands of businesses, from tiny bootstrap startups all the way up to, established tech players.
And they're all facing this same paradox.
Well, this exact paradox. How can you be breaking even, maybe even losing money on paper, and suddenly find yourself owing hundreds of thousands, sometimes millions, in taxes? It just doesn't compute intuitively.
It really doesn't. It feels like something fundamental must have shifted, right? In the tax code itself, what exactly is the mechanism here? What's causing this financial whiplash?
Well, it all boils down to this really profound but kind of overlooked change to one specific part of the U.S. tax code, Section 174.
Section 174, okay.
For decades, like 70 years, this section was basically a pillar supporting American innovation. It let companies immediately deduct their R&D costs. You spend it, you deduct it. Simple.
Okay, straightforward.
But a critical change, kind of buried deep in the big 2017 Tax Cuts and Jobs Act, it just completely flipped this on its head.
So this wasn't a standalone bill. It was part of that larger tax overhaul.
Exactly. And it functioned like like you said, a legislative time bomb.
A time bomb. How so?
It was set with a 5-year delay. So the change was made in 2017, but it wouldn't actually kick in until tax years starting after December 31st, 2021.
So people probably thought, oh, they'll fix this before it actually happens.
That seems to have been the widespread assumption. Surely Congress wouldn't let this go live, but they did. And starting in 2022, boom, the bomb went off.
And what did it do?
The new rule killed that immediate deduction for R&D expenses. And yeah, that absolutely includes engineer salaries, which is key for tech. It replaced it with mandatory amortization.
Amortization, meaning you have to spread the deduction out over time.
Right. Spread it over 5 years for research done in the U.S., or get this, 15 years if the research happens outside the U.S.
15 years, wow. And the impacts, the fallout.
It's been swift and pretty severe. People are calling it a hidden accelerant for the tech layoffs we saw. Some founders are genuinely worried about an extinction event for small software companies.
Extinction event. That's strong language.
It is, but it reflects the reality for some. It's triggering cash flow crises, forcing companies that never borrowed before into debt, killing innovative projects before they start, and, big picture, putting U.S. firms at a real disadvantage globally.
So the core issue here, the sort of key insight, is that a technical change, maybe intended as just a budget fix, has ended up creating a policy that taxes investment, not profit.
That's the crux of it. It's taxing the very act of building something new. And in doing so, it's rapidly dismantling the scaffolding that supported American innovation for decades. It's fundamentally reshaping the tech landscape, and maybe not in a good way.
Okay, so today we're going to unpack this amortization bomb. We need to go back, look at that 70-year history of tax policy that got overturned.
Yeah, understand what we had before.
Exactly. Then dissect the political maneuvering that led to this change in 2017. Explain the nuts and bolts, the arcane mechanics of how this new law actually works.
And hear from people actually dealing with it.
Yes, hear from those on the front lines, see the real-world impact. And finally, explore the fight happening right now in Washington to try and defuse this thing. The big question we're asking today is this just tough fiscal discipline, or is it a catastrophic mistake for American innovation?
It's a huge question.
It really is. So to really grasp the shockwaves hitting the tech sector right now, you first have to understand the foundation that got shattered. This new Section 174 rule, it's not just a tweak. It's a pretty radical break from, 70 years of consensus in U.S. economic policy?
70 years, yeah. Since the mid-20th century, basically, the tax code was deliberately set up to encourage private sector innovation, make it cheaper, less risky, to invest in R&D. That was the goal.
So how did it start? Where did Section 174 originally come from?
It goes back to 1954. Congress enacted the first version of Section 174. Before that, R&D costs were tricky tax-wise. Often they were capitalized, but unlike a building, they didn't have a clear useful life, so it was hard to know when or how to deduct them.
So uncertainty.
Big uncertainty. The 54 law fixed that. It gave businesses the clear option to deduct 100% of their qualified research spending in the year they spent it. Immediate certainty, much lower financial risk for trying new things.
Okay, that makes sense. And I think you mentioned earlier that policy got a boost later on.
It did, yeah. In 1981, they added the Section 41 R&D tax credit. This was a direct response to global competition heating up, especially from Japan at the time.
Right, the competitiveness angle.
Exactly. Lawmakers basically said, we need to not just allow deductions, but actively reward companies for investing in American workers, American R&D, American infrastructure.
So you had this combination. Section 174 letting you deduct the cost immediately, and Section 41 giving you an extra credit on top of that. That sounds like a really powerful incentive.
It was a really strong two-pronged signal from Washington. Innovate here, we've got your back. It became, a huge part of the engine driving the modern tech economy.
So this wasn't some loophole. It was deliberate industrial strategy.
Absolutely, a cornerstone of U.S. competitiveness, which is why analysts are now sounding the alarm, saying that weakening this isn't just about taxes, it's strategic. It could hurt our ability to compete, maybe even pose a national security risk if rivals out-innovate us in key areas.
Let's talk about that immediate expensing, the 100% deduction.
Yeah.
Its power really comes down to cash flow, doesn't it?
Yeah.
Which, as you said, is like oxygen for any company, but especially young ones.
Totally. Cash flow is king.
So if a company spends, say, $1 million on engineer salaries, being able to deduct that full $1 million from taxable income in the same year give them immediate breathing room. Why is that specific timing so vital?
Well, a couple of things. First, it just straight up lowers the after-tax cost of doing that R&D. The money you save on taxes that year can go right back into the business.
Like hiring another engineer.
Or buying better equipment, or starting a new research track. It creates this, virtuous cycle of investment and growth. Second, it provides predictability.
Ah, okay, so you can plan better.
Right. Startups, bigger companies too, they could forecast their finances much more accurately. That encourages them to take on those ambitious, maybe risky projects that they might otherwise shy away from if the tax hit was immediate and large.
And this model, this became the financial underpinning for so much of the modern tech world, didn't it? A lot of newer companies, direct-to-consumer brands, internet firms, they built their whole growth strategy around this.
They really did. Operating on what some call an engineered break-even, pouring basically every dollar of revenue right back into developing the product, hiring engineers, growing fast, knowing that the R&D deduction would shield them from taxes during that high-growth, low-profit phase.
And software development seems uniquely suited to this model.
It really is. Software is intangible. It changes constantly, needs endless updates and improvements just to stay relevant. It fits the expensing model perfectly.
And for years, before 2017, the IRS guidelines were clear. Software development costs, including those crucial engineer salaries, could be deducted immediately.
Yeah. Revenue Procedure 2050, that was the key guidance. It was critical. It meant that engineer salaries, often the biggest single expense for a tech company, could be fully written off in the year you paid them.
It recognized the reality of software, that it's not like building a factory once.
Exactly. It's an ongoing operational cost. You have to keep investing in coding, testing new features, or your software just decays. It becomes obsolete fast. That successful framework, that understanding, is what makes this current change so jarring. It's not just tweaking the rules, it feels like it's inverting the principles that fueled U.S. innovation for generations.
Okay, so we've established just how fundamental this R&D deduction was, woven right into the fabric of U.S. innovation. But the huge question is, if it was so important, so effective for 70 years, how did it get dismantled? It clearly wasn't, because everyone suddenly decided R&D wasn't worth investing in.
No, not at all. By all accounts, this wasn't a big policy debate about the merits of R&D. It was much more about legislative mechanics, a budgetary gimmick, as some call it, tucked away inside that massive 2017 Tax Cuts and Jobs Act, the TCJA.
Right, the TCJA.
So the provision that killed immediate R&D expensing, it wasn't really about making the economy more efficient or the tax system fairer. It was there to solve a very specific political math problem.
And that problem stemmed from the big corporate tax rate cut in that same law.
That's right. The centerpiece of the TCJA was slashing the corporate rate from 35% down to 21%. That's a huge cut, and it blew a big hole in projected federal revenue.
So they needed ways to make the numbers look better.
Exactly. Under the rules of Congress, they needed offsetting sources of revenue, what they call pay-fors, to make the tax cuts seem less expensive, at least within the official 10-year budget window they use for scoring these things.
Okay, so how did changing Section 174 help with that? How did going from immediate deduction to amortization raise revenue on paper?
Well, by forcing companies to spread out their deductions over 5 or 15 years, instead of taking them all at once, it effectively pulls future tax payments forward into that 10-year scoring window.
Ah, I see. So the government collects more tax revenue sooner, even if the total tax paid over the long run might be similar.
Kind of. It makes the revenue picture look better within that specific budget window. On paper, back in 2017, they estimated this change would generate almost $120 billion in apparent revenue gains between 2022 and 2027.
$120 billion. That's a big pay for.
It was, and by most accounts, it was a very late addition to the bill, like middle-of-the-night stuff, trying to make the final numbers work.
And that 5-year delay, setting it to start after December 31st, 2021, that was key to making it politically palatable at the time.
It definitely helped. It kicked the can down the road, created that, false sense of security. Oh, 5 years is a long time. Surely it'll get fixed.
But it didn't.
It didn't. And a lot of companies were apparently completely blindsided. They went to file their 2022 taxes in early 2023 and suddenly discovered, whoa, this bomb actually went off. This is real.
Okay, let's break down the mechanics then. How does this amortization actually work day to day for a company?
Okay, so instead of deducting, let's say, $1 million in R&D costs in year one, you now have to treat that $1 million like a capital asset, like you bought a machine.
And you deduct its cost over time.
Right. You amortize it. If the research was done in the U.S., it's over 5 years. If it was done abroad, it's over 15 years.
15. Wow. And isn't there some, technical quirk that makes the first year even tougher?
Ah, yes. The dreaded mid-year convention, this is crucial. The law says amortization has to start at the midpoint of the tax year the cost was incurred. Doesn't matter if you spent money January 1st or December 31st.
Midpoint. So what does that mean practically for the deduction?
Okay, take the 5-year schedule for domestic R&D. Normally you'd think, okay, 15th per year, so 20% deduction each year. But because of the mid-year convention, in year one, you only get half of that first year's deduction. So just 10% of the total R&D cost can be deducted in the year you actually spent the money.
Only 10% in year one.
Only 10%. That has a massive impact on your first-year taxable income and just hammers cash flow right when you need it.
And I remember reading there was a specific new sentence added that really dragged the whole tech industry into this definitively.
Yeah, Section 174C3, brand new, left zero room for doubt. It says, and I'm paraphrasing slightly, any amount paid or incurred in connection with the development of any software shall be treated as a research or experimental expenditure.
Shall be treated. No ambiguity there.
None. That one sentence was like a dragnet. Pulled the entire software development world, engineer salaries, QA tester salaries, product manager salaries involved in development squarely into this new mandatory amortization regime. No exceptions.
Okay, so the practical effect is this bizarre situation of phantom profits, right?
No.
Taxable income that shows up on paper but isn't actually in the bank. Let's walk through that hypothetical startup again.
Okay.
Revenue, $1 million. R&D expenses, mostly engineer salaries, $1 million. So net cash flow before tax, zero.
Right, break even.
Pre-2022 under the old rules.
You deduct the full $1 million R&D expense, taxable income, $0. Tax owed, $0. Final cash position, $0.
Excellent. Now, post-2022, same situation. $1 revenue, $1 R&D costs.
Revenue's still $1. Expenses are still in dollars, but your allowable deduction in year one is only $100,000.
Because of that 10% mid-year convention thing.
Exactly. So $1 revenue minus $100K deduction leaves $900,000 in taxable income.
$900,000. Even though the company has zero actual cash profit.
Zero actual cash profit. But they have $900 in taxable income. Apply the 21% corporate tax rate to that.
And suddenly they owe, what is the $189,000 in taxes?
$189,000 in taxes.
Yeah.
On money they already spent, money they don't have. Their final cash position goes from $0 to negative $189,000.
So you are literally being taxed on money you've already spent. You have to find cash, maybe borrow cash, just to pay the tax bill. This isn't a tax on profits. Feels like a tax on investment.
It's effectively a tax on investment. And for the American tech industry specifically, it feels like a tax on the very act of trying to build the future.
Now, while this Section 174 change causes headaches, big ones, even for giants like Microsoft you mentioned, they paid an extra $4.8 billion in taxes in 2023.
Yeah, not small change even for them.
Right. But the real devastation, the truly crushing impact, seems to be further down the food chain. Small companies, bootstrap startups, businesses just scraping by. For them, this isn't just a headache.
No, for them it's potentially an existential threat, that cash flow crisis we talked about, triggered by having to pay taxes on phantom profits. It's not just slowing growth, it's forcing founders into impossible choices. And it's fueling those warnings about a potential extinction event for small American software companies.
It feels like this policy has just completely flipped the script on the risk-reward calculation for startups. The old model was, raise money, hire engineers, build fast, operate at a loss initially, shielded by the tax deduction.
That was the playbook for decades.
Now, the very act of investing in growth, hiring those engineers, creates this huge paper profit and a very real tax bill. I mean, when you look at those phantom profit numbers, does this make building a tech company now look almost irrational on a spreadsheet?
From a purely first-year cash flow perspective, it can look deeply irrational. Think about it. A company spends $1 million on R&D, brings in zero revenue yet. Under the old rules, that's $1 million loss, no tax. Under the new rules, that's $900,000 in taxable income in year one. How do you justify that investment easily? It completely upends the financial calculus, especially for early-stage ventures.
And these aren't just hypotheticals. That Omaha software firm we started with, 46 years old, always stable, suddenly plunged into crisis, forced to take out its first ever loan just to pay the IRS for profits it never actually saw.
It's heartbreaking. And look at Interval Zero, that firm in Massachusetts. 50 people, industrial systems. The tax change caused a sudden cash flow emergency.
What do they have to do?
To survive, they had to raise prices, take out a $2.5 million loan, and they laid off nearly 40% of their staff, mostly engineers. 40%. And they said it severely hampered their ability to compete globally.
Laying off almost half your engineers just to pay a tax bill on money you didn't actually make.
Yeah.
I mean, this isn't just about spreadsheets, is it? It's hitting real people, real jobs, the core of American ingenuity.
Absolutely. And it highlights how this Section 174 change acted as this powerful but maybe unseen hidden accelerant for those broader tech layoffs in 2022-2023.
Right. Because while the big companies talked about efficiency,
this rule actively disincentivized keeping large in-house product development teams. It made those teams suddenly much more expensive from a tax perspective. Companies that were growing really fast, predicated on that R&D expensing model, like Twilio or Shopify, they had huge cuts, 22%, 30%. They were hit especially hard.
but it's not just about current jobs, it's chilling future innovation too.
Definitely. You mentioned Kyle Barkins from Tap Network in Delaware. He said his firm had $3 to $4 million in projects canceled because clients looked at the new tax implications and just balked.
So potential work just vanished.
Vaporized. And that shrinks Tap's ability to grow and invest in its own future R&D. It's a ripple effect.
You can feel the anxiety and, frankly, the anger in places like Hacker News online forums. People are talking about the disproportionate hit to startups.
Yeah, startups often don't have big accounting teams to handle this new complexity or the cash reserves to just absorb taxes on phantom profits.
And the confusion, that blurry line between new development, which has to be amortized, versus routine maintenance, which maybe doesn't. It sounds like an accounting nightmare.
It's hugely subjective and creates immense compliance burdens. There's this shared sense of almost betrayal, that a rule seemingly born from budget games is now actively strangling the very small businesses that are supposed to be driving the economy forward.
It really paints a clear and pretty devastating picture. This Section 174 amortization rule isn't some abstract policy debate. It feels like a clear and present danger to those small, medium-sized businesses, the backbone of the innovation economy. It makes those warnings about an extinction event sound less like hyperbole and more like a real possibility.
Yeah, the picture isn't pretty when you look at the individual company level.
And the damage isn't just contained within those individual companies, right? When thousands of businesses all at once are forced to cut R&D, lay off engineers, cancel projects, the cumulative effect has to be bigger, a slowdown in the whole U.S. innovation engine.
That's exactly what the emerging data seems to suggest. What started as, a budgetary gimmick is now looking like a self-inflicted wound to America's long-term productivity, our competitiveness, maybe even national security.
Is there data showing this national slowdown?
There is an early assessment from Stanford's business school. Pretty striking numbers. They estimated that just in the first year, this amortization rule led to a $12.2 billion reduction in R&D spending across affected firms.
$12.2 billion less investment.
In 1 year. And relatedly, a 62% increase in effective tax rates for those same firms. That's a major contraction.
And you see it in the overall growth trend, too.
Yeah. Before this change kicked in, U.S. R&D spending was growing at a pretty healthy clip, average of 6.6% a year. The year after the change took effect, that growth dropped to less than half of 1%, basically stalled.
Wow, less than 0.5%. And looking ahead.
Projections are worrying. One study anticipates this policy could lead to losing nearly 240,000 high-earning R&D jobs over its first decade.
250,000 R&D jobs.
And a $71 billion reduction in R&D investment overall in that time. And remember, most R&D spending, like 75% of it, is salaries for researchers and engineers. So this is effectively a direct tax on high-skilled jobs.
What's really striking is putting this in global context. This slowdown here is happening while our main economic rivals are doing the opposite.
Exactly. They're aggressively doubling down on innovation incentives. The contrast is stark.
Okay, let's take the biggest comparison, China. How do they treat R&D spending?
It's almost the mirror image. While the U.S. now forces companies to amortize R&D over 5 years, China offers what they call a super deduction. Companies there can deduct 200% of their eligible R&D expenses.
Wait, 200%. So for every dollar they spend on R&D, they get $2 in tax deductions.
That's right. $2 deducted for every dollar spent. Meanwhile, a U.S. company in that critical first year gets to deduct 10 cents.
10 cents versus $2. That's
Right.
not a level playing field.
Not even close. It creates this massive, frankly, untenable competitive disadvantage. The new U.S. policy makes investing in R&D here at home more expensive than in almost any other developed country. And that brutal 15-year amortization for foreign R&D, it just compounds the problem, penalizing U.S. companies for using global talent pools.
So let's quickly recap that global picture.
Okay.
United States, mandatory 5-year domestic or 15-year foreign amortization.
Yep.
Increases after-tax costs, hurts cash flow, discourages investment.
Right.
China, super deduction at 200%. Massively lowers after-tax costs, huge incentive.
It's huge incentive.
United Kingdom, R&D tax relief, enhanced deductions, sometimes cash credits, big cash flow benefits.
Yep, quite generous.
Canada, their SR&ED program offers refundable tax credits, often cited as one of the most generous systems globally.
They're very strong incentives.
This policy divergence, it feels like it has really serious strategic implications.
It does. When your tax code actively discourages R&D here while your competitors are aggressively subsidizing it elsewhere, that's a recipe for losing your technological edge. Industry groups are warning this isn't just about economics anymore, it's a national security threat. We risk falling behind in AI, in biotech, in defense tech, critical areas.
And there's another layer to this, maybe unintentional, about market structure, strengthening monopolies.
Yeah, that's a really important point. By creating this big cash flow hurdle, especially for new and growing companies, Section 174 effectively raises the barrier to entry in tech.
So the disruptors, the startups challenging the incumbents,
Yeah.
they face a tougher climb.
A much tougher climb. They're scrambling for cash to pay taxes on these phantom profits. Meanwhile, the established giants, the big tech firms with billions sitting in reserve, they can absorb this new tax hit much more easily.
Giving them an advantage over smaller rivals.
A significant advantage. And this creates a dangerous feedback loop. If U.S. startups are weakened, starved of capital, they become prime takeover targets.
Including by foreign competitors.
Absolutely, which could lead to American innovation, American intellectual property, ending up under foreign ownership. That's a really critical long-term threat to our economic sovereignty.
So for the companies just trying to navigate this, trying to comply with the new Section 174 rules, the challenge isn't only financial, is it? It sounds like a nightmare of complexity and legal gray areas.
Oh, absolutely. It's a descent into, a labyrinth of administrative complexity and just plain legal ambiguity. The IRS has put out some guidance like Notice 2023-63, but for a lot of businesses, honestly, it's just highlighted how incredibly burdensome this whole thing is.
What makes it so complex? What are the main pain points in trying to comply?
Well, a big one is just figuring out what counts as a specified research or experimental expenditure, SRE for short.
Mm.
These are the costs you have to capitalize and amortize. The definition is really broad. It's not just direct costs like salaries.
It includes overhead, too.
Yeah, a portion of indirect costs, overhead.
Mm.
Think rent, utilities, equipment depreciation. You have to figure out complex ways to allocate those costs to your R&D activities.
And for tech companies, that whole software development piece must be a massive headache.
It's a quagmire, total quagmire.
Yeah.
The IRS says software development includes planning, design, coding, testing. Okay, clear enough.
Right.
But it excludes things like training, data conversion, marketing. Fine.
But the tricky part is,
The tricky part is the fuzzy line between what they call a significant upgrade or enhancement, which you must amortize, and just routine maintenance, like fixing bugs, which maybe you don't have to.
how do you distinguish that consistently?
Exactly. For companies doing continuous development, constantly improving their software, making that distinction project by project, feature by feature, it's a monumental task, and it feels really subjective. It's a huge accounting challenge.
What about work done by outside contractors or consultants? Does that add another layer?
Oh, yeah. The rules there get particularly complex. It often comes down to figuring out who bears the financial risk of the project succeeding or failing, and who keeps substantial rights to the resulting intellectual property.
So it depends on the contract details.
Heavily. It creates a ton of uncertainty for both the companies hiring contractors and the agencies doing the work. We're even seeing some firms try to restructure their contracts, like framing it as a purchase of software rather than payment for development services, just to try and sidestep the amortization requirement.
Wow. And then there are these rules that just seem bizarre, like the one about abandoned projects.
Right. That one's wild. Get this. You spend $1 million developing a new software product. In year 3, you realize, you know what? This isn't going to work. Market changed, tech didn't pan out, whatever. You abandon the project.
Okay, so you write off the cost, right?
Nope. You cannot write off the remaining unamortized costs then and there. You have to continue taking the small amortization deductions for that dead ghost project over the entire original 5 or 15-year period.
You're kidding. You keep deducting costs for a project that doesn't exist anymore.
For years. It makes absolutely no sense from a business perspective, and it actively discourages taking risks on those high reward but maybe high failure rate innovative ideas.
Okay, it's also really important we clarify the difference between this mandatory Section 174 amortization and the Section 41 R&D tax credit, because I know that causes a lot of confusion.
Huge confusion. Yeah, let's clear that up.
So Section 174 amortization
Is mandatory. If you have these R&D type expenses, you must amortize them under the new rules. It's not optional. You can't choose not to do it.
Okay. And Section 41, the R&D tax credit.
That is optional. You can choose whether or not to claim the credit. But crucially, not claiming the credit doesn't get you out of the mandatory amortization under 174. They're separate things.
So the credit is calculated based on some of those same R&D costs.
Yes, the R&D credit costs under Section 41 are generally a subset of the broader Section 174 costs. Section 174 is wider, includes things like overhead, maybe some patent costs that aren't eligible for the credit.
So the credit might help offset some of the increased tax burden from amortization.
It can, yes, but it's really just a Band-Aid. It doesn't solve the fundamental cash flow crunch caused by losing that immediate deduction. It doesn't make the phantom profits go away.
And beyond the direct financial hit and the complexity, there's just the sheer administrative burden of tracking all this stuff.
It's immense. Businesses now need these meticulous, often costly tracking systems, documenting employee time spent on specific activities, allocating overhead. It's a massive undertaking.
Especially for a small startup without a big finance department.
Exactly. It diverts precious resources, time, money, focus away from actually building the product and towards accounting and legal compliance. It's inadvertently spawned this whole new compliance industry of advisory firms specializing in Section 174.
And the subjective nature of the rules, like that maintenance versus enhancement line, that must create audit risk.
Big time. It hands the IRS a powerful new tool for scrutiny and audits. Compliance becomes this high-stakes game of legal interpretation and risk management, which is not where you want innovative companies spending their energy.
So wrapping this all up, the story of this Section 174 amendment really feels like a cautionary tale, doesn't it? About unintended consequences.
Absolutely. A provision that seems to have been born from political expediency, legislative scorekeeping, that middle-of-the-night change to make a budget look balanced. It's just detonated with these incredibly profound and mostly damaging effects across the American economy.
It took a 70-year-old policy that was explicitly designed to foster innovation.
And turned it into, effectively, a punitive tax on the very act of investment. The result looks like a significant self-inflicted wound on our national capacity for growth. It seems demonstrably anti-startup, anti-growth, and anti-competitive. And if we connect it back to the core issue by forcing companies to amortize R&D, the law creates those phantom profits. That triggers crippling tax bills for businesses that are just trying to break even or invest for the future.
Igniting that cash flow crisis that hits small and medium businesses the hardest,
Yeah.
leading to layoffs, canceled projects, and that potential extinction event threat.
Right. And then you zoom out to the national scale. The policy has measurably slowed down R&D spending overall. It's threatening tens of thousands of high-skilled jobs, and it puts the U.S. at that stark competitive disadvantage against global rivals like China, who are doing the exact opposite, heavily subsidizing innovation.
Plus, it inadvertently strengthens monopolies, stifles the competition that drives progress,
Yeah.
and could even lead to losing American IP to foreign buyers. It's a bleak picture.
It is. Now, there is some good news, potentially. The disastrous impact of this policy seems to be one of the very few things that has generated broad, genuinely bipartisan consensus in Washington these days.
So Democrats and Republicans agree this is bad.
Widespread agreement. Lawmakers on both sides of the aisle seem to understand that immediate R&D expensing needs to be restored. There have been legislative efforts like the Tax Relief for American Families and Workers Act, the American Innovation and Jobs Act, bills introduced with sponsors from both parties aiming to repeal the amortization rule, even retroactively.
Okay, so if everyone agrees it needs fixing, why hasn't it been fixed? That's the frustrating part.
That is the deeply frustrating bad news. That consensus hasn't been enough to actually get it done. A fix keeps getting stalled, tangled up in the broader political gridlock.
It becomes a bargaining chip.
Exactly. The effort to restore R&D expensing gets tied to other, much more contentious political fights, like expanding the child tax credit. So despite almost everyone agreeing on the problem, a solution remains maddeningly out of reach. Businesses are left stuck in this damaging, uncertain limbo, potentially facing another tax season under these rules.
Which leaves the country at this really critical crossroads, facing a fundamental choice about its economic future. Is this mandatory amortization of R&D, painful medicine, a necessary measure for fiscal responsibility, maybe a way to make the tax code better reflect economic reality? Or is it a catastrophic, short-sighted policy blunder, a legislative bomb that's actively dismantling America's greatest economic strength, that engine of innovation?
That's the question.
You've heard the evidence today from the front lines, the founders forced into debt, the engineers laid off, the projects killed, the competitors gaining ground. The ultimate question, really, for policymakers and for you listening is, can they find the political will to disarm this thing before it inflicts truly irreparable damage on the very ecosystem that's supposed to define America's prosperity and security for the rest of the 21st century?